Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets, what we're looking at in some of our portfolios here. As always, please don't use these videos for trading purposes. They are for information only, education. Always start here with a weekly chart of the S&P 500. This is 2019 here on the left side, and the big COVID rally, and then the bear market from 22 that we went through. And then now in 23, it's actually turned out to be a better year than a lot of people were suggesting, even as recent weeks have shown a little bit of a pullback here, as you can see. But really all we've done here is pull back to trend, and we came right down here to the 200-day moving average. So still haven't done any major damage to this market as of yet. If we look at a weekly chart, we're still in an uptrend. We just maybe got a little ahead of ourselves and are pulling back there. We'll see. That could obviously change, but still the weekly chart here is constructive and shows kind of the long-term trend is still up. We come down here to a daily chart. This shows us about the last 2 years of trading, and you can see the more choppy nature of what we've had. I mean, it's really unbelievable the last year or two, how many rallies and then quick sell-offs, and it's just nothing steady, but you just have to follow the overall trend. You can see that here, we did start a bit of a downtrend here through August to now. I have highlighted the trend line here, and we're below some of the moving averages. It's still above the 200 and still above the major support here that we just recently bounced off of. But still, the daily trend is in a downtrend. So you could have for us maybe half of your long-term money is still invested based on the weekly, but based on this daily chart, we are in a little bit of a downtrend here for the last month or two. If we look down in a little further detail, this is a 2-hour chart, and this basically gives us about the last 6 months trading, nice detail of the trends that are going on for over a couple of weeks and such. And you can see the channel that we're running in here as we go through that downtrend that I highlighted on the daily chart. Did kind of come down to chart support there and bounce off, and maybe we're just going up and it'll be another rollover as we work our way down in this. But we are seeing a little bit of support here from Friday, as well as today the markets are bouncing a little bit, so that's nice. One of the things I like to do to look inside and try to get a gauge of which direction is going to help us is sometimes to look at the market breadth. And this line right here, this is the percentage of the S&P 500 that's in an uptrend. Right now, it's only at 29%, so it's actually quite low. I mean, except before the downturn came, we were up at 80% in July, and you can see it's just steadily rolled off here, which means that basically a very small percentage of the stocks in the S&P 500 are holding up the market to the extent they are. So we're going to need to see that change and bounce, or likely we are going to go back through that 200-day moving average, and things could get worse. Next one down here, this is the advanced decline line on the New York Stock Exchange. Kind of shows us how many stocks are advancing to declining, and it's not as disastrous as the bullish percentage there, but it's still rolling off a bit over the last month or so. So it's not exactly positive. One nice thing, we are getting a slight uptick here in the last day or two. So if that's worth anything, not really sure. I'd call that sideways at least. The bottom line here is the volatility index, the VIX, and this shows in the options market what people think the volatility of the stock market will be. It had gotten up about 20, and it's coming off a little bit now. It's now back below 18, so that could be a good sign for the market. But overall, I would call the breadth indicators not so great, and so we definitely be cautious. In most of our portfolios, we're sitting in a pretty decent cash position, certainly not down to zero or anything like that, but right now a 25% sort of allocation to cash until we see that if as I said, if we go back here to the weekly chart, if this is going to break down, if we do get down below that, then that might need to be a little more aggressive about how defensive we're playing. If we come here to, I've showed this before, this is really the root of all of our problems, the interest rate on the 10-year U.S. interest rate here. It's getting up to 4.8. percent in that neighborhood. Just as the Fed has come in and raised rates to try to stave off inflation, it just keeps going, and the bond market is just really killing it. And as higher interest rates go higher, the cost of everything for everybody goes higher, whether buying cars or mortgages or anything like that. And also some of the measures we use to value stocks makes stocks worse from that perspective. So not a great thing to have interest rates continue to go higher, but they're doing that for now, and until that loosens up, I think if we do get above 5, that the stock market may not hold at that level. So something very much to watch. And that's what we do for clients here. We come down to the economy. Trading Economics, great site, has a lot of this data here. We look at the GDP growth rate, and it's just hanging around the 2% level. Has been steady in that sense. So not recessionary yet, but not great numbers, but they're okay. Come to non-farm payrolls here, the jobs number. They're actually still doing fine, as they have in recent months, still adding some jobs. It's not great, but it's some. Unfortunately, inflation has ticked up in the last reading a little bit, but it's still not the 9% that we were seeing a year ago. And then if we come down here to retail sales, they're still holding in there. So consumers still buying things. That's still working out. But all of these, again, not fantastic numbers. And then let's see if we come over here to forward earnings on the S&P 500. This is from YCharts to give us basically the analysts what they expect the S&P 500 companies to earn. They're not calling for it to roll over. So it's still positive on forward earnings, despite everything that we're seeing. So all that's great. And overall, it makes I'd say everything pretty mixed. If we come here to valuation, I'd like to show these. This line here is what the market should be at if about a 20 times earnings. Right now we're higher. I want to say I don't have the chart. It's I think somewhere around 25%, 25 times the earnings on the S&P. So maybe we're a little overvalued, but not horribly so. So I would say overall things are mixed, sort of average. We could have just another sort of sideways action for another year or so even. But for right now, what we have is a long-term chart that's saying we're still up, we're still holding on to this, but sort of barely. And some of the internal measures are not looking fantastic, including the interest rates. That's a bit of a scary thing, but as long as that holds, we'll hang on to still some long positions here. But it's certainly bears watching, and we're watching very carefully every day for our clients and removing risk when necessary. To that end, let me put in here our contact information. If there's anything you'd like to hear about in future videos, or you'd like to reach out and hear about what we're doing for our clients, feel free to reach out anytime. Other than that, we'll hope this was informative and helpful, and we'll see you at the next update. Thanks so much.